How's it going? It is I again, your boy. Yeah. Coming out straight from M5 Property Addicts, and I've got my boy Lebo. And Lebo and I, we are both property investors, and we do this every day. And we are predominantly in the rental space, so we buy properties and we rent them out. Lebo does it slightly different, and I'm going to give him a chance just now to talk about who he is. But you know that when we are together, we are talking about tax and property and tax and property and property and tax. You name it, whatever it is. If you've been around with us and you haven't subscribed, but you are listening to our property and tax and property and tax and property, and you are not subscribing, you are not doing us a favor. Subscribe so that the others can also get the same knowledge that you are getting. Right. Over to Lebo, who is my co-host, and we talk about this tax thing. And Lebo, he is the founder and the CEO, and he's got 15 degrees in tax, and developer. And Lebo, how's it going?
I'm all good. How are you, my brother, TJ?
Oh, good, man. Oh, good. Great. A good week, brother?
I had a great week. I had a productive week. So we are having a lot of traction, especially now the economy is opening up. I think things are going to get a lot better for everyone. I'm hoping that there's a proper plan to recover the economy from where it is now. But there is a positive side and positive light that is coming. So we're happy, man. I think overall this week has been good.
Right. You're sounding like a politician. We and you're wearing a suit as well. You know, you're like, okay.
No, how's your week been? How's your week been?
No, mine has been good, man. I am doing okay. I am chasing month end so that we can get. There's a small building that we bought. It's a 20-unit one, and. Okay. I'm kind of like buying it whilst the existing seller is still in the deal with me. We're busy trying now to get into the building and to manage it ourselves. And that comes with, I think that's also something that we can talk about here, because Lebo, you also have blocks of flats that you've got.
Yes.
And when we are going into moving in, my happy place is that I move in when the building is empty. But sometimes you have to inherit tenants, right?
Yes.
Now, that transition of you getting paperwork from the previous, or should I say the seller, and to you now, how have you managed that? Because for me, it's like we need to have a round robin team, a team meeting with my guys, because I'm the one who was buying this. We've concluded the sale. I need to bring on board all of my legal team. I need to bring on board all of my acquisition team, my management team. There is meters that you need to have sight of. There is the actual building. There is insurance. There's a whole array of things that needs to be taken account of.
100%. Yes.
And what is your process that you utilize here without us diving deep into it? For me, it's simple. I acquire. I bring my team together on one meeting. We spread all of the tasks, and at a particular day, we all need to have a firm handle on it, and we move in.
So the first thing that I do is I obviously analyze how they were doing things. So what kind of tenants they have and what kind of agreements they have, lease agreements they have with their tenants. And then I obviously also involve my team in terms of all these processes, my acquisition team, also my management team, also my legal team, so that we draw up, so we normally draw up new lease agreements with these tenants all together, so that we don't inherit certain clauses that we're not aware of.
Right.
So yeah, to avoid unnecessary things. So we will just take the tenants. Yes, we inherit the tenants, but we then sign a new lease with them. Obviously, we negotiate for terms and stuff like that. But overall, we just inherit the tenants, but we bring them into our system. We're not inheriting the old system that they were using. So we're inheriting the building and the tenants, but the system is our system. So we don't have to change anything from our side in order for us to ensure that our business continue to run smooth without inheriting problems that we are not aware of.
Awesome stuff. And the key thing is here is who is in the building, right? And the relationship is now with you.
Yes.
And I think this goes for whether you've got a big block of flats or whether you've got a 1 bed, 2 bath. The process is still the same. But the higher the bigger you get in terms of scaling, the bigger the work that needs to be done. On a 1 bed, on a 2 bed, 1 bath, you can do it on your own, right? And you don't need a team. But the moment that you start scaling up, a team is now required.
100%.
Good stuff. Right. So today we are going to be talking about something that me and Lebo would possibly never experience in our businesses, because we buy properties and develop and we rent them out. But for some people, they like to do these things that is called buy and sell. And Lebo, I know that you do buy and sell sometimes. I prefer not to do it, right?
I also don't. I don't buy and sell. So the only time I sold, it was because of an opportunity that I saw, and the other time that I sold under my company, it was because of the model that we are using, so, and the type of property that we had at the time. So they were not speaking to each other. So hence we decided to sell. And as a result as well, some of my investors, they were looking for a quick return on investment as well. So, but the company's culture is for long term. So we buy and develop to rent out, not to sell. We don't sell. We hardly sell. So there was just few incidents where we have sold in the past, but the mandate of this house is to buy, rent out, buy, develop, and rent out. So predominantly we do developments of complexes and done anything else really.
And I think this is why we get along, me and you, because our mission is the same. It's about acquiring assets and getting tenants to pay off our debt. And we reap the benefits of it. But obviously we need to provide some form of housing, a safer environment, a laker neighborhood where they can obviously be. Yeah. So having said that, capital gains, that's what we want to talk about today. But if you're in the rental space, you would never experience capital gains, right? What is capital gains, Lebo? You are the tax guru here. I'm not. That's why you wear a t-shirt. You know what I mean?
So, in simple terms, capital gains is payable by individuals, trust companies to the receiver of revenue. In South Africa, it's SARS, South African Revenue Services. It's payable when you sell a property that has increased in value since you've purchased it, and it applies to those purchased on and after. Or after October 2001. So that's when the capital gains tax in South Africa was introduced. In the world, you can trace it all the way back to the 1800s from America, but in South Africa, it was only introduced in October 2001. However, that said, there is also an exemption that applies to primary residents. That has been the property that the owner lives in on a permanent basis.
Okay, so I think let's dissect it a little bit, and I think this session here today is an educational session around capital gains. And I'm going to throw a lot of scenarios to you, Lebo, as we go along, and we just want to unpack where does capital gains apply and what should you be doing. And we have just realized that as a property investor, whether you are developing, whether you are buying for the purposes of rental, you will never be able to pay capital gains because that doesn't apply to you. And that's why me and Lebo do that. So that's the first bucket of individuals. The
Yes.
second one here is the person label that I'm going to say. You said it applies to companies, to trusts, individuals, right? So that's kind of like every entity here.
Yes, everyone that makes it, that is able, that has an ability to make money, they apply. It's applicable to them.
Okay, cool. The next question then I would want to ask Lebo is that, right, when does it kick? When does the capital gains kick in? You said that when there is a appreciation on the property that you've got, right?
Yeah.
But there's an exemption here if it is your primary residence. So which means that a trust is not a person, a company is not a person, so they can't have a residence, can they?
There's also special trusts. Then that special trusts, they do have exemptions as individuals. So there are special trusts that are treated as individuals to an extent. So
Okay.
that's where the exemption comes in.
Right. And I think this is where we say that if you are not so sure in your team, and if you're serious about property, whatever trust that you have, you then now need to check in with your tax guy to say, hey, am I exempted? Am I not? But again, if your trust is all about rental properties, you are not going to have capital gains. When then does capital gains apply?
It applies when you sell your property at profit. So let's say I'll give you an example. When you've bought say a property for about 2 million, and let's say you bought it in 2002, and then you've held on to it until 2020. Now things that are a bit shaky. Now you decide to sell your property. Let's say it has appreciated, and now the market value of the property is sitting at 10 million. So that means your capital gain is now sitting at 8 million. But now there's exemptions that comes into play where you, depending if it's your primary resident or your secondary property or your investment property, then it's treated differently. That's where you consult your tax practitioner or your accountant. Then they'll be able to advise to say, look, in your case, because you bought it as an investment property, or in your case, because you've bought it as your secondary home that you've been using for rental purposes, or you've been using it as an office space, or if you've used it as a primary residence, so you have an exclusion of up to 2 million that the government, our partner SARS, allows us to have a benefit of. So it's treated differently depending on your position that you've bought in and what you've been used it for. So that gap between 2 million that you bought it with, it's called base cost, and then what you sold it for, the sales price. Then there's a capital gain of about 6 million there, so you need to account it for it. So depending on your position and what you've been using it for.
I think that's pretty clear, but I want to, you know, these books that are, if you go to CNA, there's these books that are called Dummies for What, Dummies for What.
Yeah,
And
yeah.
I always see myself in that space, you know what I mean? Because it explains things at a granular level. And therefore, I want us to jump into a few particular deals.
Okay.
Where I'll give you the scenario and you need to tell me, does capital gains apply there?
Yes.
Or not, right? So I am one of those, Melissa, that's my name, and I went to a property seminar and I realized that I can make money in property. They said that you can flip. So I went to buy a property in Randbeck and I bought this property for 800,000. I renovated it for another 100,000 and now I sold it for 1.5. So at the seminar, they didn't talk about taxes and all of those things, right?
Yes. Yes.
And now I'm selling and I work at the bank, right? So I got a personal loan to do my 100,000. The bank gave me the other money to buy the property. So it's kind of like all of it is other people's money. You know, at the seminars, they talk about other people's money.
Yes,
right?
yes.
So now at the end of the year, the bank have sent my IRP.
Yes.
And all of a sudden, SARS is claiming to say that I need to pay them some more money.
Yes.
Right.
Yes.
Could that money be as a result of my deal that I did here, which is a capital gain?
100%. So there's a capital gain in terms of so remember you bought the property for 800,000.
Right.
Now you've spent 100,000 to increase the value of the property.
Right.
So that is capital gain. So now between what you've spent, which is 900,000, so that means the 100,000 is also an exclusion. So they will calculate that as an exclusion, and then the 600,000 is going to be counted for as a capital gain. So they are depending whether you did it under a company or on your individual capacity, then or under a trust, then there's percentages that applies to that in terms of what percentage is should be included in your, because it's not a separate tax return. You must account for it or submit it or declare it under your income tax as a capital gain. So, and then it will be taxed at your inclusion rate, whether it's 20%, whether it's 18%, whether it's 40%, your inclusion rate will be taxed at your marginal tax rate. Let's say you are, for instance, if your tax rate under your income tax is sitting at 40% or 41%, then that means your inclusion rate, whether it's 18% of your capital gain, is included in your income, and then it's taxed at your income marginal tax rate.
Which is 40% in this case.
Yeah, in this case, which is 40%, but it's 40% of 40% of 18% or 40% of 22%. So depending on where you are. So let's use, for instance, a 22% as an example. So you have 600,000 as capital gain. Right. So they're going to say your inclusion rate is 22%. So that means you're going to calculate 22% of 600,000. Then include it in your income tax, then it's 40% of the 22%.
Right. Now, yeah. Having said that, Lebo, you were thinking that you are making 600 profit.
Yeah. Yes.
All of a sudden, it's less than that, right?
100%, yes.
But that's from an individual perspective. From a company perspective, it could be up to how much?
It's still the same. So there's an inclusion rate. So it's up to, I think it's 40% that you can. We'll just have to verify that. But I think it's up to 40% that you need to include. That's your inclusion rate that you get taxed on.
Right, but with those two in mind, Lebo, I've done this in my personal capacity, and I'm doing it in the company now. So, but from a tax perspective, when you are now submitting.
Yes, so from a tax perspective, so the company can only be taxed up to 28%, nothing more than that. So, irrespective of your inclusion rate, so if your inclusion rate, if your capital gains tax is 40% of your profits, of your capital gains, that is included there, that means you only going to pay 28% of your inclusion rate. So, irrespective of how much you've made, or irrespective of how much you have included in your income tax, so you're only going to pay up to 28%.
So by doing a flip, right, because this is
Yes.
where capital gains kick in.
Yes.
Doing it in your personal name, you might have a con where you can be paying up to 40%, depending
Up
on
to
your
45. Actually, it's up to 45%.
up to 45%, depending on your current
Tax.
income, right? And this income here, the 600,000 that we spoke about, so that can push you up to 45%. So all of a sudden, you're no longer making the 600 that we were thinking that the deal is going to make.
Yes, 100%. Right? Yes.
And all of a sudden now we say, hey, this property thing doesn't work for me. Oh, they lied to me at the seminar.
Yes.
And
so,
we just didn't know the terms and C's of a flip.
100%. So what you're basically saying, TJ, as in this regard, let's say you are your income, it's now you are making 500,000 per annum. So, but now because you have made an extra, because you're doing a flip in your personal capacity, you've made an income of about R1 million. So that has pushed your bracket from that of the 500,000 to that of the 1.5 million, of which is the highest tax bracket currently in South Africa. So now your tax rate has increased from your normal, maybe 28% or 18%, whatever the case is. It has pushed it up to the highest tax bracket in the market in South Africa. Now you need to pay tax at 45%, no longer at your 18% or your 45%, because you've now made more money, because that is income tax. And then on top of that, that income is also regarded as capital gains. You now have to also declare your capital gains tax on top of that.
However, Lebo, this is the worst case scenario, right? And by no means I'm trying to shock you, but this is from an educational perspective, that this is why we and Lebo have this conversation, so that when you know that you're going to make 600, you know for a fact it's going to be 600. But let's reverse the tables here, Lebo. I am unemployed, and I have very little income coming through. Again, on the same deal, I had my 800. Maybe it was from my mother, because she saw that I've got the passion of property, so she gave me the 800, and my brother gave me 100,000. And at SARS, I only have a tax number, and I used to work 3 years ago. And this 600 is my only income that I've actually received this year. The tables here, from a tax perspective, are they still the same, or things are different?
No, they are different, because now remember your tax bracket. At that level, it's 18% of every R1 that you make. So now that is before rebates.
Right.
So that's now when you have, the benefits of doing it under your personal capacity, because now whatever your inclusion rate is, they're going to just tax you 18% of your inclusion rate in terms of your capital gains tax.
Awesome stuff. Same deal, different outcomes.
Yes, depending on where you are as an individual, a company, or a trust, or a special trust.
100%. Okay, good stuff. So that's the point number one, right? Around the capital gains label. And we've just covered the individual here, but I want us to jump into a company now. So I'm doing this in a company. What applies what we have spoken about in at an individual perspective? What then applies so that we can follow the same deal? Again, it's an 800, 100 Reno, 1.5 we have sold it. This looks like achievable deals or flips. It's common numbers.
So in terms of a company, so companies, they don't have, the benefits of, your exclusions in terms of your primary residence and stuff like that. But however, there are also benefits, because now you remember you bought at, let's say you bought at 800, you spend 100,000. So for 100,000, that is for your renovations.
Right.
And then there's also this applies also to individuals, because you also incur your transfer duties, your commission to the to the agent. You also incur things like your rates and stuff like that. If you did not deduct those items under your income tax submissions, then you can add them on your base cost in terms of capital gains calculations. But that's where your accountant or your tax practitioner can help you with in regards to those items. But then that means you let's say you spend 100,000 on renovations, but you spend another 200,000 in terms of commission, rates and taxes, your transfer duties, transfer costs. So that pushes your cost to 1.1 million. So your base cost is 1.1 million. So now your capital gains is no longer 600. Now it's sitting on 400,000. So now whatever your inclusion rate is, so they're going to calculate an inclusion rate on the 400,000 as opposed to the 600,000. Then, and then you're going to be taxed up to 28%, nothing more than that under a company.
I would want to do it in a company if it were me.
Of course. I mean, the highest tax bracket as a company that you can ever pay, it's 28%, nothing more than that in South Africa.
Awesome stuff. Whilst we're still talking of the same thing, label on this capital gains thing, I think it is fair for us to actually say, people always look at the deals and then they say, what about capital gains? And depending on how you're going to do it, it might be in your favor or it might not play in your favor, right?
Yes.
So deal making, it's all about looking at all the possible things that can happen into a deal. If I renovate, can I still stay in my budget of 100,000? If I'm buying it, am I putting in an offer on 800,000? Am I still making money if I put in this 100,000? And what is the market going to be? And over and above that, what is the best way with my circumstance now, right? For me to also be able to walk away with a good, for the tax to work in for my position where I am. And many a times we don't do that. We just continue doing projects. We just continue, right? And in my team, we are very conscious now around when a deal is coming through, all parties needs to be involved on the deal, right? Because
yes.
Each one is wearing a different hat A legal person is like that structure. Yes, from a legal perspective, that's sharp. And from a tax perspective, you're going to pay a lot of it. So it's not a one-man game where you're just willy-nilly going to do stuff on your own. You come from a seminar and you start to do these things without having partners that you can come on board and consult for you to get the best solution for the deal.
100%. So that's why in seminars, even in those seminars, that's why they always emphasize the fact of having a power team, having a team. So that means your power team needs to involve or include people that are wearing different hats that will help you, irrespective of how good of an entrepreneur you are or how good of a negotiator you are. You can't be master of all things. You can be jack of all trade, but you'll be master of none. And then being a master of none, that means you have a lot of loopholes that you would miss, and it might come back later on and bite you.
Okay, good stuff. Lebo, I think the information around capital gains, we have kind of like stretched it, given it a bit of examples. In closing, is there something that you want to share with the viewers? What is it that they need to really be careful around? And what is it that they should be doing? I think we've covered everything, but from a closing perspective, summary, what is it that they should be doing to make sure that they are not on the wrong side of tax? Tax is there.
So the best thing to do for yourself, it's always to consult the relevant parties. Always consult the relevant parties. When I say the relevant parties, I mean a qualified person that is qualified to give you an opinion, not your uncle that has read about capital gains on Google one time and then he comes at a bride and tells you what or your cousin that has had his tax accountant talking about capital gains tax, and then he comes and wants to be the smart one at the bride. Tell you about capital gains. But on a serious note, you need to consult your relevant parties that are qualified, that are more qualified to give you the right advice, and that can help you grow and achieve your goal that you've always wanted to achieve. I mean, if you have a correct, competent team around you that can help you succeed and accelerate your growth, I think that will be best for you to do so. So you might think it in a sense that hiring these people or consulting with these people, this is going to cost you money. But I can tell you right now, from where I'm standing or I'm seated, is that you are saving more money than you'll ever think, because the mistakes that you might or most likely going to commit or fall into are more costly than the premium that you would have paid once off or on few occasions just to get you where you want to be. So that few thousand rands that you pay to your power team, it's nothing compared to the price that you will pay for the mistakes that you could have avoided. So I think it's very, very important to get in touch with your tax accountant or tax consultant or tax practitioner, your business accountant, your CA, that will be able to assist you in terms of taxes, to avoid tax, because you don't want also to find yourself evading tax.
Right.
You're not aware that you're evading tax, but if SARSman comes, they won't be lenient on you, because that's why there's people like your tax practitioners in place in order for them to help you and to make you aware of the things that you don't know. So to avoid being on the wrong side of the law, I would suggest that get the right information, consult with the relevant, competent people that will be able to help you to get you where you want to be, without having to fall into a pit that you might not get out of.
I like that label. I think the bottom line here is that we have long defined SARS as our partner, and for every partner, even a spouse, there's the bad and the good side of the partner, depending on how you are behaving.
True.
Yeah, so SARS is a good partner if you're behaving well, and they can be a terrible partner if you're not behaving well. You might not know that you're behaving inappropriately, but either way, the taxman will always be available to give you your good 10 smacks ones. Yeah. And as investors, we don't want to be caught because that can be a very expensive exercise.
100%.
It is over and out from me and Lebo. Lebo, you want to sign out for us?
Guys, thank you very much for watching. We'll catch you later at the next video. Take care.
Awesome. God bless. Cheers. Bye.